stop. Before you trade in that old car, before you sign any paperwork at a dealership, you need to hear this. The IRS just opened a tax loophole that could put thousands of dollars back in your pocket, and hardly anyone is talking about it. I'm talking about real money, money you can use for groceries, grandkids, medical bills, or that trip you've been putting off. But here's the catch, and this is critical. This window is only open until 2028. Miss it, and you could be leaving $10,000 on the table. I'm not exaggerating. I'll prove it to you in the next 12 minutes. I'm going to show you exactly how to qualify, what mistakes will disqualify you, and the one thing your car dealer will never tell you about this deduction. Alright, here's what's happening. For the first time in nearly 40 years, the federal government is allowing everyday Americans to deduct the interest they pay on car loans. This is part of the One Big Beautiful Bill Act that passed in July of 2025. And it's specifically designed to help working families and retirees afford a reliable vehicle. Now, I know what you're thinking. Interest? That's not the whole car payment. You're absolutely right, but stay with me here because the numbers might surprise you. Let's say you finance a $30,000 vehicle at 8% interest over 5 years. That's a very typical situation right now. In your first year alone, you're paying roughly $2,300 just in interest. Over the full life of that loan, you're looking at nearly $7,000 in total interest. Under this new law, you can deduct up to $10,000 of that interest per year. Now, depending on your tax bracket, and many of you watching are in the 12 to 22% range, that could translate into real tax savings, $1,500, $2,000, or even more over the life of the loan. And for those of you on fixed incomes. For retirees watching every dollar, for seniors who need a safe, reliable vehicle but have been putting it off because of the cost, this changes the conversation entirely. But here's where this becomes time-sensitive, and I need you to listen carefully. This deduction only applies to vehicles purchased between January 1st, 2025 and December 31st, 2028. That's it. We're already in late December of 2025, which means you have about 3 years left in this window. And here's something most people don't realize. If you bought a car in cash earlier this year, thinking you were being smart by avoiding interest, you missed out. If you traded in your car in 2024, you missed out. This deduction only applies to loans taken out after December 31st, 2024. The clock is already running. Now, I'm not saying you should rush out and buy a car you don't need. What I am saying is this. If you've been on the fence about replacing that 15-year-old sedan that keeps nickel and diming you with repairs, if you've been worried about whether you can afford something more reliable, if you've delayed a purchase because of today's interest rates, this tax break may be the thing that finally tips the scales in your favor. But, and this is critical, you have to do it the right way. Because there are very specific rules that can disqualify you faster than you can sign a loan document. Let's walk through who qualifies and who doesn't. This is where expensive mistakes are going to happen if people aren't careful. First, income limits. This is the big one for many of you. If you're filing as a single person, your modified adjusted gross income needs to be under $100,000. If you're married and filing jointly, that limit is $200,000. These are phase-out limits. That means if you're slightly over, you may still qualify for a partial deduction. But if you're well over these amounts, the benefit disappears entirely. For many retirees living on Social Security, pensions, and modest retirement withdrawals, you're likely under these limits. But if you're still working part-time, if you took a large IRA distribution this year, or if you sold property, you need to run the numbers carefully. Second, the vehicle itself must qualify. And this part is very important. The car must be new, not used, not certified pre-owned, brand new, purchased in 2025 or later. If a dealership tells you a gently used vehicle qualifies, that is incorrect. Next, the vehicle must be assembled in the United States, not sold here. Assembled here. This is a major requirement. Many popular imports don't qualify. Your Honda Accord may not qualify if it was assembled in Japan. That Toyota Camry might not qualify either. You need to verify the final assembly location, and I'll show you exactly how to do that in just a moment. The vehicle must also be for personal use, not business use. You cannot double dip by claiming this as both a personal deduction and a business expense, and it must be a car, minivan, van, SUV, pickup truck, or motorcycle under 14,000 pounds. Standard passenger vehicles qualify. Large commercial trucks do not. Third, the loan requirements. The loan must be taken out after December 31st, 2024. So we're talking loans from this point forward through 2028. The loan must be secured by the vehicle. That means the lender holds a lien until it's paid off, which is standard for most auto loans. And you must be buying the vehicle with the loan. This does not apply to refinancing an old loan. If you refinance a qualifying loan later, that may still work. But an old loan from last year doesn't suddenly become deductible. Now, I know that's a lot to take in. And I know some of you are thinking, this sounds complicated, but stay with me. Because next, I'm going to show you exactly how to verify eligibility and claim this deduction correctly without hiring an expensive tax professional. Let me show you what this actually means in real dollars, because that's what matters. Example 1. Meet Margaret. Margaret is a 72-year-old widow living on Social Security and a small pension, about $45,000 a year total. Her 2008 sedan just failed inspection, and she needs something reliable. She finances a new Chevy Equinox assembled in Tennessee for $32,000 at 7.5% interest over 6 years. In her first year, she pays about $2,300 in interest. Margaret is in the 12% tax bracket. That deduction saves her roughly $276 on her federal taxes that first year. Over the life of her loan, she'll pay about $7,800 in total interest, and if she stays under the income limits, she could save nearly $1,000 in taxes. For someone on a fixed income, that's real money. Example 2. Meet Robert and Linda. They're a retired couple with combined Social Security, pensions, and some IRA withdrawals totaling $90,000 a year. They're under the $200,000 limit. They need a reliable vehicle for visiting grandkids 3 states away, so they finance a new Ford F-150 assembled in Michigan for $48,000 at 8% interest over 5 years. Their first year interest, about $3,700. They're in the 22% tax bracket. That deduction saves them over $800 in year 1 alone. Over 5 years, with about $8,500 in total interest paid, they could save nearly $1,900 in federal taxes. Now, some of you are thinking, but I could just buy the car in cash and avoid interest altogether. And normally, you'd be right, but here's the twist. With this deduction, the effective interest rate you're paying drops significantly. If you're paying 8% interest but getting back 20% of that in tax savings, your real cost is more like 6.4%. For many seniors, it actually makes financial sense to finance even if you could pay cash, especially if that cash could stay invested, earning returns elsewhere. Alright, so how do you actually make this happen? Here's your step-by-step action plan. Step 1. Verify vehicle eligibility before you buy. Before you fall in love with a car, check where it was assembled. Go to the National Highway Traffic Safety Administration website, that's nhtsa.gov, and use their VIN decoder tool. You can plug in the VIN right there on the lot and verify final assembly location instantly. Do not skip this step. Step 2. Keep immaculate records. your lender is required to provide you with a statement showing how much interest you paid in 2025. They can do this through an online portal, on your monthly statements, or in an annual summary. Make sure you get this by January 31st, 2026. Save your loan documents, save your VIN. You'll need all of this when you file. Step 3. Calculate your modified adjusted gross income. This is basically your adjusted gross income with a few add-backs. If you're not sure how to calculate this is where you might want to spend an hour with a tax professional, or at minimum, use tax software that walks you through it. Don't assume you're disqualified. Verify your actual number. Step 4. File correctly. When you file your 2025 tax return in early 2026, you'll report this interest deduction. The IRS is creating new forms for this, and tax software will be updated to include it. You do not have to itemize to claim this deduction. It's an above-the-line deduction, which means you can take the standard deduction and claim your car loan interest. This is huge for most seniors who don't itemize. Step 5. Don't trust everything the dealer tells you. I'm going to be blunt. Many car salespeople don't understand tax law. Some might tell you vehicles qualify when they don't. Some might not even know about this deduction. You need to verify everything yourself. Be your own advocate. Now, I need to give you some warnings because I care about protecting you from mistakes. Warning 1. Do not buy a car you can't afford just for a tax deduction. This benefit might save you $1,500 over a few years. That's wonderful. But if you're stretching yourself thin on a car payment you can barely make, that defeats the entire purpose. The tax savings is the cherry on top, not the reason to buy. Warning. 2. Do not trust verbal promises. Get everything in writing. Verify the assembly location yourself. Verify the loan terms yourself. I have seen too many cases where people were told things that turned out not to be true. Warning. 3. Do not assume you can claim this for a lease. You can't. This is only for financed purchases where you own the vehicle at the end. Leases do not qualify. Warning. 4. This is temporary. After 2028, this benefit disappears. If you need a car in the next few years, don't wait until 2028 and risk missing this window entirely. Look, I started this video by telling you about a hidden opportunity and I meant it. This car loan interest deduction could genuinely change the math on whether you can afford a safe, reliable vehicle in your retirement years. For too many seniors, transportation becomes a crisis. You're driving cars that are unsafe, that break down, that you're pouring money into. You're worried about taking that road trip to see family because you're not sure your car will make it. You're delaying medical appointments because your vehicle isn't reliable. This tax break won't solve every transportation problem, but for those who qualify, it can make the difference between staying stuck in an old clunker and driving something you can actually depend on. The key is being informed, being strategic, and taking action during this limited window. If you found this helpful, do me a favor. Share this video with another senior who might need to hear it. Hit that subscribe button so you don't miss future updates on tax law changes that affect retirees. And drop a comment below telling me, are you planning to take advantage of this deduction? What vehicle are you considering? I read every comment. Remember, knowledge is power, but only if you use it. Don't let this opportunity pass you by. I'll see you in the next video. Until then, stay informed, stay empowered, and take care of yourself.